This video will change your life as a trader if you watch it till the end. In this video, I will talk about the mathematics of winning in trading. By the end of this video, you will understand why losing 60% or even 70% of your trades can still make you profitable. I will show you how this trader turned $400 to over $200 million. And you will also understand how this trader named Takashi Kotagawa could turn his $13,000 to $156 million. Every profitable trader out there has to understand the mathematics of winning in trading. And if you stick around till the end of this video, you too will have your eyes open to the realities of trading. I'm going to show you what the actual math behind winning, why your strategy was never the problem, how probabilities work in trading, and even a coin flip strategy can make money. By the end of this video, you'll stop thinking like a gambler and start thinking like a professional. Let's dive in. Part 1. The expectancy maths. Everything starts with one concept: expectancy. Expectancy answers one question. On average, how much do I make per trade? Not one trade, not your last trade, but over a large number of trades. The formula is expectancy equals win rate times average win minus loss rate times average loss. Let's say you win 50% of the time. You make $200 when you win. You lose $100 when you lose. So 0.5 times 200? 0.5 times 100 equals 50. Expectancy equals plus $50 per trade. Even though you're only right half the time, you're still profitable. That's the shift. Professional traders don't think, will this trade win? They think, does this system have positive expectancy? Because over time, math always wins. Also understand this. Each trade is independent, meaning your last trade doesn't affect your next one. A losing streak doesn't cause a win. The thing that changed my own trading personally was the fixed risk to reward system. I started trading 1 to 2, and I had a win rate of about 47%, and I made profit that year. I backtested my strategy and saw that it worked fine. And that was the shift in my trading career. Before then, I was already about to give up on trading because nothing seemed to work out. I was always blowing accounts month after month, but then I realized something. If you can consistently blow accounts, why not do the exact opposite of what you are doing? That was when I decided to look deep, and I then discovered what I call the win rate and risk to reward mathematics. This brings us to part 2, the win rate versus risk to reward maths. Here's where most traders get it wrong. They think high win rate equals success, but that's incomplete. There are two variables: win rate, risk to reward ratio. Example 1, high win rate, bad RR. If you have a win rate of 80%, which means risk is $100 and reward is $50, you will win often, but lose big when wrong. This can cause you to be unprofitable. Example 2, low win rate, good RR. If you have a win rate of 40%, risk is $100 and reward is $300. You will lose often, but the winners are big. This can cause you to be profitable. This just shows you that your win rate being 40% does not make you a failure. If you understand the maths of winning and trading, 40% is healthy depending on how your trades are structured. Let me tell you about a trader named Richard Dennis who grew his $400 account to an estimated $200 million with just a 29% win rate. This is real. And he didn't do it in one day. No, it took him a solid 18 years to achieve this. Let me break it down for you. In 1970, after paying $1,200 for a seat at the Mid-America Commodity Exchange, he was left with just $400 in actual trading capital. By the end of the year, he had grown it to $3,000. This looks like small progress to a lot of the fake flippers on social media, but it is real. In 1973, which was 3 years later, he grew his capital to $100,000. In 1974, which was a year later, he made a single profit of $500,000 trading soybeans. By the end of that year, at age 25, he reached his first million. In mid-1980s, his personal wealth peaked. In 1986 alone, he reportedly made $80 million. From 1983 to 1988, during the famous turtle trading experiment, his students generated an additional $175 million in profits in just 5 years using his exact rules. And what are his exact rules? Dennis's strategy was entirely mechanical, removing the emotional itch to trade. He used the following rules: the 1% risk rule. He never risked more than 1 to 2% of his total account on a single trade. This survival rule ensured he could withstand long losing streaks without going bust. I know you are probably thinking, is 1% not too small and slow? How is it possible that he was able to make so much risking so little and his win rate was less than 30%? This sounds like BS, but then I realized something. That is where the power of compounding your trades come into play, but we will talk about that later in this video. His second rule was his trading strategy. He only traded breakout entries. He typically bought when an asset hit a 20-day or 55-day high and sold when it hit a 10-day or 20-day low. His third rule was the volatility adjustments. He used the average true range to adjust position sizes. In volatile markets, he traded smaller. In calm markets, he traded larger. Can you see how his rules are not so fancy? Can you see how they are boring? Can you see how it is not complicated? This is exactly how your own trading should be too. In the end, Richard Dennis became famous for turning $400 into an estimated $200 million with a low win rate. Dennis proved that you don't need to be right most of the time to be rich. His turtle trading experiment showed that a systematic approach beats gut feel. All he did was catching monster trends. Dennis was a trend follower. He accepted that 70% of his trades would be small losses, getting chopped up in sideways markets in exchange for catching the 30% that turned into massive, sustained runs. He understood the power of asymmetry. His strategy relied on a high risk-to-reward ratio. He might lose $1 on 7 trades, but make $20 on the remaining 3. And that was simply how he made it big as a trader. But he did not become rich in 1 or 2 years. He traded the same thing over and over. Through the storm and the rain, even in difficult times, he repeated the same thing till he became successful. Now ask yourself, if you lost 7 trades in a row consistently, don't you think you might lose your mind? Anyway, this is just a typical example of how win rate alone means nothing in trading. What matters is the relationship between win rate and reward versus risk. Stop asking, how can I increase my win rate? Start asking, does my system make money over 100 trades? Does my system make money over 1,000 trades? You should always consider the outcome of your trades in a large sample size, because it is only in a large sample size that your edge and your consistency can be truly tested. And that brings us to part 3, the mathematical estimate of losing streaks. Now let's talk about something that destroys most traders, losing streaks. Even profitable systems have losing streaks. Not sometimes, always. Understanding the mathematics of expectancy will help you understand that having losing streaks is impossible to avoid. This makes us understand why we must all practice risk management. This is why stop losses should be non-negotiable. Before we dive into how losing streaks work, let us look at this beautiful expectancy curve by Nick Raj. This shows the inverse correlation of win rate and win-loss ratio. You can see that the more profit you are trying to shoot for, the more likely you will lose. That is why no trader can ever in this life have a high win rate on a high RR. Any trader who tells you they hit 90% of their TP and their RR is 1 to 5, that person is a big fat liar. Unless the person has insider information, and good luck with that having insider info in a $7 trillion market. Even the banks don't have that information. Anyway, like I was saying, the more profit you shoot for, the more likely you lose. I know you are probably thinking, but I have seen traders flip their accounts a lot of times. You need to understand that flipping can only work if you understand the statistics behind it. Take a look at the Skyrocket Signals Trade Return Simulator for a bit. Now we have established the fact that there is no way anybody has a high win rate with a high risk and high reward, right? Good. Let us assume that you have risked 50% of your account trying to target a 1:5 RR, and we all know that your expected win rate with this should be 20% maximum. In 50 trades, how will that turn out if you fund your account with $1,000? Your account will get blown every single time. There is no way around it. Profitable traders don't operate this way. What you see online is people doing trial and error with other people's money. They don't show you the blown accounts, they only show you the one that clicked. Now let us look at how losing streaks work and the maths behind it. What are losing streaks? Losing streaks are simply what I call drawdowns. It is you taking back-to-back losses on your account. This is totally normal as trading is a game of probabilities. Prices can either go up or down. There is no other direction it can head. It is like you trying to flip a coin. It can either end up in heads or tails. There is no other surface it can land on. And if you go back to study the probabilities behind the coin flip and expectancies behind it as well, you will realize that trading is no different. If you are targeting a 1-to-1 RR, it is equivalent to you expecting that the coin lands on either heads or tails. If you are targeting a 1-to-2 RR, it is equivalent to you expecting that the coin lands on heads 2 times consecutively. Now imagine your target is to get the coin to land on heads twice. Don't you think it will be much more likely that you lose in between? Don't you think that in the process of flipping your coin to make it land on heads twice in a row, that it will likely land on tails at a point? This just goes to show you how losing streaks can occur. The higher your RR, the more likely your losing streak. This is exactly why traders have a period in the market where their account balance drops. We can refer to this as drawdowns, and it is caused by losing streaks. Let us look at this spreadsheet. I will include the link to this document in the description. This table shows you your expected losing streak according to your sample size and win rate. The sample size here is simply the number of trades taken. You will see in this table that if we place 1,000 total trades, it is expected that in between these trades, a losing streak of 19 trades should be expected if you have a 30% win rate. A losing streak of 16 trades should happen if you have 35% win rate, and so on. And if you have a win rate of 99%, you should still expect to lose 2 trades. This is the formula for how this spreadsheet table is formed. This formula is from Nick Raj, and it is based on probabilistic theory. This formula helps estimate losing streaks over large sample sizes. In the end, all I am trying to say is that you should plan your trades in such a way that you will make room for some consecutive losses and not expect the markets to favor you all the time. This is simply how big organizations organize their risk management. They plan. It is important to note that even a 90% win rate can theoretically lose 100 trades in a row. This is very unlikely to happen. But if it does happen, we should be looking at a very large sample size of trades, meaning that one would have taken billions, if not trillions of trades for that to have occurred. This just shows you that you need to use stop losses no matter what your back-tested win rate is. Let us take a look at the Skyrocket Signals Trade Return Simulator for a bit. I built a trade simulator so you can simulate your back-tested win rate and risk to reward across a large sample of trades. Here is how to use it. Input your capital or balance in this field here. Input your risk here, your win rate here, your number of trades, and finally, when inputting your RR, just write the number here. If your RR is 1 to 2, just input 2, because 2 divided by 1 is 2. If your RR is 1 to 3, input 3 because 3 divided by 1 is 3. But if your RR is 2 to 1, you should input 0.5 because 1 divided by 2 is 0.5. Got it? Now to see the final by 2 is 0.5. Got it? Now to see the final outcome, click on Run Simulation, and it will generate and test your inserted parameters across random trades. Please read the entire instructions on this page to understand the simulator better. This simulator helps you better understand how your losing streaks can affect your account. You may increase the risk and see how it will kill your account too. Just play around with it and imagine different scenarios. The trading simulator will make you understand that. Anybody could have a really terrible losing streak at any time. I am pretty sure now that you can see why people who risk their entire accounts will never get to experience the true reality of winning in trading. Even if you have a 90% win rate, if you risk 100% of your account, you will end up blowing your accounts over and over again. Even if you fund 3 accounts, you could blow all 3 of your accounts due to the fact that you risked all your capital per trade. You could end up giving up, and you begin to wonder why trading is not working for you. After you blow your accounts, you begin to strategy hop. You begin to look for what isn't lost. You pay stupid mentors to teach you new garbage. Meanwhile, nothing was wrong all along. You didn't just understand the mathematics behind trading. Losing streaks are not a sign your system is broken. They're proof you're playing a probabilistic game. Professionals expect drawdowns. Amateurs panic. Part 4, the gambler's fallacy. There is usually a belief every trader has, and it is that after a series of losses, a win is due. This is what is called a gambler's fallacy. You think, after I lose 5 trades in a row, the next one has to win. But mathematically, that's false. Each trade is independent. The market doesn't owe you a win if you keep thinking like this. This behavior will lead you to increasing position size, revenge trading, blowing accounts. The market has no memory. Only traders do. In conclusion to all I have said, here are things you should note moving forward in your trading journey. 1. Losing streaks are inevitable. Drawdowns must happen. 2. Risk management is key to successful trading. You will last long enough to make those millions you always dreamed about, just like Richard. 3. Stick to your plan. Plan your trades, trade your plan, and give yourself time. You can only see results in compounded trades, and you cannot compound trades without factoring in time. 4. The outcome of each trade doesn't care about your setup. Even A+++ setups will fail, and non-A+ setups will win. 5. Your brain will try to trick you, and every time your brain tries to trick you, please come watch this video again, because this is the only video that exposes the truth behind trading. This video teaches you the real maths of winning and trading. Follow the maths. 6. You have free will to do whatever you like in trading. You can risk any amount and trade anyhow you like. And this is what B-Book brokers are exploiting. They will trade against beginners because they know beginners will end up blowing their account. If you keep trading without following your plan, you will end up donating your money. And lastly, join my Telegram channel. Let us grow together as a community. In the next 2 to 3 years, our lives will never remain the same. Again, if you like this video, give it a thumbs up and subscribe to this channel. Also watch this video where I talk about the compound effect of risking 1 to 2% per trade to help broaden your knowledge on good risk management. I will see you in the next video.